I'm looking at the splash this weekend from your shop in the Financial Times. They gave one Daniel Iveson, I think he's an intern with Pimco, front and center headlines. Bond fund giant Pimco prepares for, quote, harder landing for global economy. How does econobabble fit into total return in the fixed income market?
I think that view from Dan Iverson, Group CIO, is just a cautionary note. And it's all relative. When we say hard landing, we're saying relative to perhaps what others are expecting. At Pimco, we're expecting a soft landing, but that may be harder than others are thinking. So in terms of a total return type portfolio, a Bloomberg aggregate style portfolio, which of course is a collection of bonds, treasuries, mortgages, corporates, mostly market cap weighted, you want to be up in quality, of course. We think if there is a slowdown or a recession, the credit spreads could widen. The broader point is that one needn't take a lot of duration risk, credit risk, etc., to get good yields in the bond market. We're looking at 5%, 6%, 7% type returns in assets we think are so-called money good. So you needn't take a big leap. Consider, for example, Tom, where high yield bonds are. Even though they may be attractive to some, we'd say be cautious in the area at spreads of over about 400 basis points or so, 400 to 450 on average. It's kind of tight relative to what could happen in a recession with a spread of, call it, let's say, 800 basis points or more. And a widening of that magnitude can, in a total return style portfolio, be painful because there would be losses. And so we're saying prepare by keeping your powder dry and don't reach so much. You needn't these days with where yields are.